Welcome to part 2 of Interest Rate Risk in Banking book. Before we start, let's take a look at the current state of economy. So we know that inflation is being sticky and not slowing down anytime soon. And Fed and other central banks are giving a knee-jerk reaction by raising rates to bring inflation under control. June CPI data at 9.1% is out, and food and energy are the major contributors. With ECB raising rates by 50 basis points last week, we await Fed's decision, which is predicted to raise rate by another 75 basis points. Investors and traders have nowhere to hide, be it stocks, bonds, FDs, crypto. All asset classes are in negative zone and no one is able to provide the inflation hedge. In April, the IMF had already slashed its forecast for global economic growth by nearly a full percentage to 3.6% for 2022-2023. The World Bank has also slashed its global growth forecast by nearly a third to 2.9% for 2022. Major indices like S&P, Dow Jones, Nasdaq have given their worst returns. With expectations of increasing rates, we discussed about part 2 of our topic, that is interest rate risk in banking books. So to understand about the bank's balance sheet and the composition, please watch part 1 of this series. Let me jump to the duration gap analysis, which is another way to manage the interest rate difference between the assets and liability side. So today I will talk about impact of interest rate on market value of asset and market value of liability. We will look at a simple balance sheet of the bank to understand the concept. Asset component are cash, 1 billion, other assets like 3-year commercial loan of 7 billion, 6-year treasury bond worth 2 billion. Please note that cash doesn't generate any income for the bank, so total asset generating income in the balance sheet is 9 billion. So we talk about two rates which are associated with the assets earning interest, that is the coupon rate and the YTM. So coupon rate associated with commercial loan is 12% with 12% YTM and 8% for the treasury bond. Coupon rate is defined as the interest rate of the bond calculated on the face value. And YTM is the expected return earned by holding a bond until maturity and reinvesting all cash flows at this rate. The relation between YTM and coupon rate is if the face value of the bond is if a bond is trading at a value less than the face value, then YTM is greater than the coupon rate. If a bond is trading as a face value, then YTM is equal to coupon rate. And if the bond is trading at a value greater than the face value, then YTM is less than the coupon rate. Now coming to the liability side, we have 1-year time deposit of 6.2 billion with 5% interest and 3-year CD of 3 billion with interest rate of 7%. So total interest bearing liability is 9.2 billion. Remaining part is equity of 800 million, which is non-interest bearing. Now that we have understood the balance sheet components and terminology of coupon and YTM, let's look at duration. Duration is nothing but rate of change of bond price with respect to YTM or the interest rate. We have two types of durations, modified and maculate. Let's talk about modified duration. It is the change in price of the bond with 1% change in the rate of interest or YTM. Second type of duration is maculate duration, which is time taken to pay the price of the bond using its internal cash flow. It is the present value of the cash flows multiplied by time and divided by the price of the bond. Let's look at maculate duration of assets and liabilities of a balance sheet mentioned before. So we calculate the coupons cash flow, refer to column B, and the present, then we calculate the present value of the coupons, refer to column C. Now, since YTM and coupon rate is same, that is 12%, the price of the bond is 700, which equals its face value. Now we calculate the numerator, which is total value, column D, multiplying by the present value of the coupons with the tenor. So maculate duration is calculated by dividing the numerator by price of the bond and measured in years, which is 2.69. And modified duration is macula duration divided by 1 plus r, which is r, where r is YTM. And modified duration is measured in percentage terms. And it means that if interest rate or YTM changes by 1%, the bond price will change by 2.54%. We shall do the same exercise for bond 2 on the asset side and for liabilities. I have attached the Excel in the link. So the total weighted duration of assets is 2.53, refer column I, and the total duration of liability is 1.4%. And duration gap is calculated as duration of assets minus duration of liabilities into market value of total liabilities divided by market value of total assets, which comes to 1.16%, which means that banks need to reduce the duration gap by taking position in liabilities with at least 1.16 duration of liabilities. Also remember that bond price and YTM have inverse relationship. That is, if YTM or interest rate increases, the bond price will decrease. Typically, the value of fixed rate bonds will fall when interest rate rise, and the value of fixed rate bonds will rise when the interest rates falls. So that was all about the duration and the interest rate shocks in the banking book. Thanks for watching. Please like, share, and subscribe. Thank you.